current macroeconomic and political environment, it's pretty much impossible to say with certainty what the next year will look like in a lot of respects. And I wondered just quickly if you have any sort of top of your radar risks to the industry, whether that be monetary policy, holdups and stimulus, or simple infrastructural problems.
Yeah, I think the Fed basically backstopping a lot took a lot of the credit risk out of the market that was there back in 2008. So a lot of that has gotten out. You can argue whether or not the PPP stimulus was allocated correctly, whether the extra $600 on the unemployment, worked. But if you look at retail sales and you look at some other macroeconomic items, it looks like a lot of that seemed to get back into the economy. There's going to be winners and losers at the end of this, and there's going to be bankruptcies, and there's going to be turnover in ownership. Those things will all occur. But I think what the Fed and the government has done to get us to this point is worked. And so they were early and started things as soon as they realized it was a major issue. So considering all that went on, I think the economy itself right now is in a good spot, but the longer this goes on, the more it's going to be a problem.
In that sort of context, if you're an emerging manager or a first-time fundraiser, actually, what do you absolutely have to do? What do you have to keep in mind in the current fundraising atmosphere if you want to be successful in raising a fund?
I think you have to have that expectation that it's going to take longer than you think it is. So therefore, if you're leaving another fund to start your own fund, the amount of cash you need to carry you until that close happens and then you can start generating management fees is going to be much longer. So the anticipation of what your capital to get it started would be is going to be more now than it was in previous years. So that, and a lot of times we'll talk to fund managers that are raising their first fund and they already have a bunch of people committed. But we tell them until you've got a check and it's cleared your bank, you don't have an investor. So you may hear a lot of conversations and people be willing, but you ultimately need them to cut a check and sign the subscription agreement. And sometimes that doesn't happen. They get distracted with other investments and things don't go the way you plan. So you have to be prepared for that over a longer period of time.
Given the current environment and the certainty of low rates for a long time, I would think that investors are more sensitive to returns overall than ever before. And I wonder if the balance of power when it comes to what fees are charged to the fund and what comes out of the GP's pocket has shifted between GP and LP, and whether you expect that trend to continue in the future.
That's kind of gone back and forth. After the crisis back in 2008, there was definitely pressure on fund managers in terms of their fees. In kind of response to that, over time, you've seen different offerings. A fund may offer a standard 2 and 20, and then offer, or you have an option to do a 1 and 25 or a half and 30. So we've seen different options come out of that. But I think the smaller funds that need to cover expenses, if you're raising a $200 million fund and you have to register and they have compliance costs and a lot of other things that go with that, it's hard to reduce your fees past 2%. You need that to kind of just get by.
Do you think that there's anything else in the industry, like the 2 and 20 model or fees and expenses generally, that will see, sort of great or fundamental change in the future?
We have seen some fixed fee caps on the management fee piece. So, they're capped at a certain number of a certain dollar amount. So the investors don't want the manager to make money on the management fees. They want them to make their money on the carry. So we have seen more of those. Haven't seen a lot of changes in actual rate. We haven't seen the 2% come down. But that all depends on who's got the upper hand over time. And we're too early in this crisis to see where we are. If returns start coming down, you may see some changes in docs, but a lot of the funds that we're looking at now, they're still using the 2 and 20 model.